Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix with Paul Sweeney, John Tucker. This is Bloomberg Intelligence Radio. I want to get back to this data because it is moving the bond market in particular. The 10-year yield's now down by a full 10 basis points, kind of encroaching on the 200-day moving average. All in that consumer confidence data, falling the most since August of 2021. Joining us now is Stephanie Guichard, a senior economist at the Conference Board. What led this decline in confidence?
So first, this decline in confidence was broad-based across income and age groups. And it was really driven by a return to pessimism in terms of expectations for future business condition and future employment.
Stephanie, it seems like when we had the election, there was this burst of optimism across a number of fronts, including the economic front, that perhaps the Trump administration would be very pro-business, pro-growth, less regulation, lower taxes, all that kind of. The data kind of suggests that is fading a little bit. Is that how you interpret a data point like this?
So I think what you were mentioning before was reflected in our CEO confidence index that surged over the last quarter. So we published this last week. In terms of consumers, they are really focused on the short term, on what's happening right now to inflation, to the job market. We saw some increase in the price of some key staples for consumers, like the price of eggs. And this is really affecting their mood and how they think about the economy.
Is this data bifurcated in terms of party lines? Because what we typically see, say, in the UMich surveys, that Republicans feeling good, Democrats feeling bad, particularly under President Trump.
Yeah, so that's still the case. I mean, Republicans are feeling much better than Democrats. But what we saw this month is a decline across the board. Strong decline for independent and Democrat consumers, and a slight decline also for Republicans.
Stephanie, thank you so much for joining us. Really appreciate it. Stephanie Guichard, senior economist for the Conference Board, joining us from New York via Zoom.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We bring you all the top news in business, economics, and finance. We're broadcasting to you live from our interactive broker studio right here in Midtown Manhattan. Just taking a look here at the markets, as John Tucker was just talking about, we're around the lows of the session. The Nasdaq is now up by almost full 2 percentage points. The S&P off by 1%. The semis are also getting hit quite hard, but really the rollover picked up a little bit of steam after that U.S. consumer confidence data fell the most since August of 2021. Carol Schleif is Chief Investment Officer at BMO Family Office and joins us now. Carol, I know you look longer term, but what do you make of the market action we've seen over the last 3 days? It feels like the buy the dip is sort of losing some steam here.
Well, maybe the buy the dip is, but it's important to remember, too, we hit all-time highs a week ago. So, and markets have gone a very long period of time without the normal level of volatility that you'd see. You would expect a 5 to 10% kind of pullback in the normal range of things. We haven't really seen that. And so for markets to come a bit off that U.S. exceptionalism story and look at, there are a lot of moving parts going in the economy right now. But consumer confidence, business confidence, some of that stuff is starting to waver. We came off of the elections with a lot of exuberance in both places. And it's important to look at those numbers and realize that people are just kind of like it's been an awful big barrage of news in the last 45 days. And so taking a step back to take a breath and process some of that is pretty normal.
So, Carl, I know you folks over there at BMO Family Office take a longer term view here, but putting in the context that we've had investors in 23 and 24 had really good equity returns north of 20%. How do you kind of reset here for 2025? What are the conversations you're having most often with your clients?
Well, I think a piece of it, too, is to realize that having ballast in the portfolio and having balanced portfolios didn't work in 22, but it definitely has worked some in 23 and 24. And so having some high quality fixed income in the portfolio, being willing to take some trims in there and sit in cash that's yielding 4.5%, 5% is a pretty nice way to balance some of this off in the short run. Now, not trying to time it all the way in or all the way out, but there is an ability to be able to have some of that dry powder, if you will, on the sidelines. And we wouldn't be alone because clearly Warren Buffett has a lot of dry powder as well.
Oh, yeah. It was $11 billion in interest in money market funds.
Right.
330 some odd billion in cash sitting there.
Yeah, I'll take that. What we have seen,
Right.
though, is money kind of flows starting to move out of the U.S. and into Europe. Do you think that that actually is a trend that has legs?
Yeah, we do think that you've got that. You know, you've had a lot of conversation around Trump tariffs notwithstanding that there is an appreciation for Chairman Xi, for example, and there's a suspicion that all the tariff talk is because he wants to cut a deal there. So we do suspect that you've got a lot going on. And it's interesting because I saw some stats yesterday that talked about the performance in ETFs since Inauguration Day. And when you look at that, the US is flat, China's up close to 20%. And so you've got a lot of different interesting things going on there. And we have recently just actually taken a country position in China specific, as well as a Japan specific one that we've had on from a house view standpoint for a very long period of time.
Well, talk to us about that China call, because we just had a segment we were talking with Bloomberg Economist just about the tariffs and the trade situation with China. So what is your view on China these days?
Well, I think another piece of it is when you look at the technology leadership that they've gotten, not just DeepSeek, but you go back to 2015 when they first initiated the China 2025 plan, industries they wanted to own, and the 10 years they've had to really focus on them. There's a lot of technological innovation and workaround, and the more we restrict advanced technology from them, the more they try to figure out how to make it work. And so between that and the beaten up valuations, not just in China, but in Southeast Asia in particular, there's a lot of interesting things going on there from trying to balance off the world. And it's always been a challenge. We've always led with, if you will, with globally diversified portfolios, but that's been a really hard argument to make in the last few years as the U.S. markets have so vastly outperformed so many others. But we think you're seeing a broadening out of that. So having balanced portfolios. And the key challenge is for long-term investors is never knowing exactly when those non-U.S. markets are going to move.
Interesting. All right, Carol, thank you so much for a few minutes of your time. We really appreciate it. Carol Schleif, she's a Chief Investment Officer, BMO Family Office here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of the other big global economic issues out there for global trade is the U.S. relationship with China. It got tough under Trump's first administration. President Biden kind of keeping some of that rhetoric up as well. And now the second Trump administration trying to take it up another level. So we want to get a sense of kind of where this may go. And there's no one better to speak to than Tom Orlik. He's the senior economist. I mean, he is the Bloomberg Economics Chief Economist. Lived and worked in Beijing for many years, so he really, really understands what's going on over there. Tom, give us a sense of kind of how you think the second Trump administration is going to approach China and maybe how China will react.
Well, it's great to be here, Paul. So I think it's interesting. I think there's going to be two rival groups who are kind of jockeying for position in terms of shaping Trump's second-term China policy. The first group, well, that's the China hawks. That's the folks who think China's catching up with the US way too fast. It's playing fast and loose with the rules on global trade, on intellectual property. And the US needs to take a really, really strict stand on this. And the second group, and you saw them on stage at the inauguration, well, that's the tech titans. It's folks like Tim Cook, who have the entire supply chain or a substantial part of their supply chain located in China. It's folks like NVIDIA, who have a huge part of their business, depending on China's electronics supply chain. So, of course, that group would very much like to see something which looks more predictable, more stable, more open in terms of US-China relations. Early days, but we've got some reporting from Bloomberg News saying that Trump officials are speaking with the Netherlands and speaking with Japan about further toughening controls on China's access to semiconductors. So what that suggests is that the China hawks, at least for now, are trying to set the agenda.
So based on that, we're taking a look at the SOX index, the semi index, down over 1.5%. So let's just go with the idea that we'll see stricter curbs on chips. Will it work? I mean, we saw what happened with DeepSeek, for example.
Yeah, it's a great point, Alix. I think if you were speaking with one of the folks that did the export controls in Biden's first term, they'd probably make a couple of points. So the first is that the first round of export controls, the Biden administration told everyone about it 6 months before it came into force, right? And that's a kind of fairly obvious misstep, right? If you tell China in 6 months' time you can't buy any advanced semiconductors, well, of course, China is going to spend 6 months assiduously stockpiling those advanced semiconductors. And then the second thing I think those China hawks would say would be, well, we always knew China was going to catch up pretty quick on the large language models. We knew they were only a few months behind ChatGPT, so DeepSeek wasn't a surprise. The export controls are really aimed at preventing China from taking that next step towards autonomous general intelligence.
Tom, based upon your experience in China, how do you think President Xi and the Chinese government will, I guess, respond and deal with this Trump administration? Did they understand how transactional President Trump can be, and therefore maybe there is a quote unquote deal to be worked out to maybe just avert some of the bigger issues?
So we've had this news overnight from Bloomberg reporters on the Trump team speaking with their counterparts in the Netherlands and Tokyo. So clearly there's nothing going on US-China policy. At the same time, if we think about where the major focus of attention for Trump has been in his first few weeks, well, it's been on Ukraine, it's been on Gaza and the Middle East. There have been tariffs on China, certainly, but there's also been tariff threats against Canada, tariff threats against Mexico. So China, relative to where I think we could have been, doesn't appear to be the kind of top of mind agenda item for the Trump administration. Now, I don't have, a hotline into China's leadership compound. I'm not privy to Xi Jinping's inner thoughts. But my guess would be that's kind of good news from their perspective, right? And they'd be pretty happy if Trump expends all of his energy focused on Ukraine and the Middle East and near neighbors, and perhaps doesn't spend so much time thinking about China and China's rise as a geopolitical challenger.
All right, Tom, always appreciate it. Thank you so much, Tom Orlik, Bloomberg Economics Chief Economist, joining us on potential chip controls over China and then the ramifications of that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix Steele and Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City. We're also streaming live on YouTube. So you can head over to youtube.com and search Bloomberg Podcast Live, and that's where you'll find us. Well, after the close tomorrow, NVIDIA reports, and that is always a big day for NVIDIA shareholders, I think for technology shareholders as well. And as the markets overall, really for the last couple of years, NVIDIA has been a market moving event. So we want to get a little bit of a preview there. And then we're also going to talk hamburgers. How we make the connection there, I don't know, but we'll try to do it.
I like it.
Kim Forrest, founder and chief investment officer of Bokeh Capital Partners in Pittsburgh. So Kim, I'd love to just take advantage of your technology chops. What should we be looking for when NVIDIA reports tomorrow?
Sure. Well, I'll say what I say for absolutely every company. Who really cares what happened last quarter? I want to know what's going to happen next quarter and the quarter after that. And I think never has this been more important than for a company like NVIDIA, who is at the forefront of a very new technology that, literally hundreds of billions of dollars are being thrown at. So the question that we have is this: is it for real? Are people still going to pay up? Are they still going to, build these huge data centers to run something that we don't have a problem that we can identify that the money is fixing? That is the question.
And what do you think that's going to be? Best guess.
Yes. Well, for a couple of reasons. Firstly, I'm a nerd. I'm a proud nerd.
No, we feel you.
I was a software engineer in AI doing stuff with neural networks. How lucky are we that this all has come up and I know about it? Okay, but anyhow, here's the problem. The only thing that I can see that large language models really solve is the ability to get information in and out from humans to computers a little bit better. And who's going to benefit? I say right now, it looks like search, that people are using it to search. They love it. And all these other kind of higher order, smarter things, we're not really able to pull off, take care of my travel to go to Sydney, Australia, right? And here are the dates, and get me the cheapest, fastest airline there. It can't do that. Not yet. Maybe not ever. We don't know. Who cares? But right now, I think the companies that are putting money into this are those that have some sort of search that they're trying to maintain their market share. So Google, I'm talking to you, and to a certain extent, Meta, right? And Microsoft is the third one. So those people are going to continue, or those companies are going to continue to pour money into this area for the foreseeable future.
All right, here's the hard pivot from AI to hamburgers. And here's my take on the hamburger business. Wendy's, I will stack up a good old Wendy's burger against a lot of the new ones out there, whether it's the Shake Shack, the Five Guys, all that kind of stuff. The Wendy's burger hangs in there. How about the stock here, Kim? What do you guys think about Wendy's here?
It has not been hanging in. That's the first thing, right? New is always better. People go, hey, let me try that Shake Shack. And then they're going to drop a lot of money and go, well, that was an okay burger, but okay, next time, maybe I want to do something different. That's one of our theories, is the growth of Shake Shack is going to reintroduce people to a good hamburger. Like McDonald's has its own flavor profile. It's not like a regular hamburger that you'd make at home. And I guess Wendy's isn't either because it's square, but we move on from that, right? Anyhow, back to it. No, the company's been trying to grow in breakfast, and that has impacted its earnings. And we're looking past that saying, hey, they've got a good idea. They're mostly a franchisee chain. The company owns, some of the restaurants. This is a good model. And, we're hanging in there thinking they have a pretty good product. And it might be time to look at it because it's sold off recently.
So how do you pick between all the fast food guys? It's sort of like, can you own a lot of them at this point when you have exposure to inflation, when you have exposure to the consumer?
Well, I kind of go on my own, right? Because I'm a consumer and I'm kind of a picky. I like really high quality stuff, but I don't want to pay a lot for it. And Wendy's kind of fits that profile in many ways. First of all, they skew to a higher income buyer than a lot of the other chains. So that's something that I like. And I also like that in any sort of consumer oriented pick, because I think there was news out yesterday, maybe by Bloomberg, that the top 10% is spending more than they ever have. And they spend on things like hamburgers, right? So we like that. We like their salads. In the summertime, they get a lot of traffic away from Panera, again, because it's a value option and it's convenient. So that's kind of my view. I don't want to own the whole lot of them. I want to own companies that are poised to beat the competition.
How about on the cost side, the cost of beef? I know that's been an issue for everybody.
Cost of beef is And here's the problem. They're fresh, not frozen, so they're buying from America. They don't really have the luxury that a lot of the other burger chains who are buying from South America and Australia. So that is an issue, and that's something that we're all going to have to suffer through for a little while here. But hey, I hear there are these things called tariffs. I don't know.
Yes. Truth. Hey, Kim, always good to catch up. Appreciate you, Kim Forrest over at Bokeh Capital Partners. Thank you very much.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.